right. Good morning, everybody. I was a little surprised at the move that happened between the close at 4 and opening back up at 6, but I guess I shouldn't have been surprised. I don't think any of us really should have been surprised. They were talking quite a bit about the power of a single CEO to drop the market the way that he did. It wasn't the fact that Snap missed necessarily. It was what the CEO of Snap said during the miss that had a lot to do with the way things changed after 4 o'clock. The market's already starting to rebound from it. At the very least, we can expect a gap close or an attempt to close the gap. But the way we run the morning briefing, the way we always have, we want to continue to do it. So we first look around the world, ask questions. What happened after I walked away from my machine? What happened in the overnight hours? I tend to use Koifin for this. It's a free thing. It does help if you at least sign in or sign up, but you don't have to have a paid account. As I often do with the morning briefing, I try to point out places that you can get the right information without having to have an account and without getting drowned in too much information. And this does that. As you can see, there's maybe 9 articles that happened in the overnight hours, and this is latest news, so I can scroll quite a bit and see articles. But if I keep it strictly on global markets, what happened in the overnight hours, there's 2 articles, 2 things that I need to see. So there's not too much information, and that's a really big deal. Not a lot going on. Still got the Davos situation. So far, we haven't seen anything over there, or nothing coming out of there, I should say, that has been impactful. We've been using Finance Juice in the morning to point out anybody who may be speaking. So we've got European Central Bank at 5:45 is talking. There's a deputy governor speaking. Kind of move through all that, get through home sales. You got Powell speaking today at 11:20, and then additional auctions. The 2-year at noon. Um, European Central Bank Christine Lagarde is going to be speaking. Bank of England, someone's going to be speaking. So it's a full house today. There's going to be a lot of speakers. When you take these speakers and you combine them with these additional auctions, we've got an opportunity all day today to see a market continue to reshape the narrative. Typically speaking, we stick to something, right? If we're bullish, we stay bullish through the different time zones. If you think of the market in 3 different phases, the morning phase, lunch, and then the afternoon, we generally will stick to one bias through each zone. But on a day like this, we have the capacity to keep changing our bias. One thing about Financial Juice that's really useful is this European market wrap. It'll give you a heads up of what was going on around the world. Very often it'll tell you what sector is leading right now in Europe and what sectors led over in Asia. Right. And what we see oftentimes is a carryover or a bleed through. So, like yesterday, it was energy in Europe and that bled over into the US, and it was finance in the US yesterday. I mean, that was the only thing that carried us yesterday, finance. If it wasn't for that, things would have been a lot worse. So we move from that over to Thinkorswim, bring up the market watch, go to the calendar. If yours looks like this and it's just really full, it's got a bunch of junk all over it, just turn everything off and turn on Econo Day event. Take the description, set it next to the times just to make things easy for you. 9:45, 10 o'clock, 11 o'clock, 12:30, 1 o'clock. It's a full house all day, almost every hour on the hour. You have some kind of econ. If you thought yesterday was rough, this isn't going to be any better today. One of the nice things about yesterday, I don't know how nice you want to put it, is the advance versus the decline in the S&P 500 was solid as a rock all day long. So that slow grind was validated all day in that one tool, nowhere else. Everything else was um, fake outs and reversals, and it was too responsive or not responsive enough. But the 80 was spot on all day. So you got to give credit where credit is due. And the NDX perfectly traded to its pivot points. So what do we have for today? As usual and every day, the market can do one of three things: stick the zone, break out of the zone to the upside, break out of the zone to the downside. So we're looking at the S&P. The zone that we want to focus on first is all of yesterday. It's yesterday's lowest point to yesterday's highest point. If we're sitting in that, then we're in an inside day. But that's a very large range, and we can narrow that range down considerably if we break this range down into zones. Globex low to the Globex high, that would be one zone. And then from Globex high to the high of yesterday would be a second zone. So if these are the two zones that we have, each of them considered one large zone, then this would be an inside day, and we would be focused on any trade strategy that leans on an inside day breakout. The S&P right now has an ADR of 3%. We're down 1%. So we want to put 2% to the downside on top of this. Kind of ask the question, what would a downside move look like? 38.50 would be a 3% move, and it would not be considered extreme. This would be our kind of run of the mill every day, just a typical bear move. 38.50. We could move that far today, and it would not be considered extreme or unusual. That would be a normal move. Beyond that, if things really start to get nasty, then we would focus on, say, Friday's low for the next target below that. That'd be around 38 flat. And beyond that, we would want to focus intraday on our own measurements, what we have past that point that we would focus on, which would be like your intraday fibs, um, using the quant tool that Thinkorswim recently added, the quadrant lines, something like that. We got two downside targets: our normal everyday and then our extreme. So if we were to have some positive news, or at the very least, if we were to try to reclaim our drop from last night, we first need to get back to where we closed. So around 39.79, 39.80, right? Some round numbers. So from our current location, we would retrace the 1% that we're down, and then we would add 3% to that. So just from our current location, we'll make a 4% move. And that gets us very close to 4,100. I don't think that's the one I want. Now, to get to the 4100 ADR measure to move, we would have to get through Tuesday's highest point. So I went ahead and marked the round number at 4100. But really, if we're that close, the most important one that we would need to focus on would be that highest point from Tuesday. It's very, very close to our own ADR target, anyways, and that would be the one worth calibrating or worth focusing on. But moving that far would just be a typical ADR move. And just like on the downside, if this is what our normal move looks like, then we really want to ask the question, what would it look like if we got really bullish? So from that, lean out a little bit more. Um, Usually we would do something like the MMM and add to that. We don't have the MMN. There is no MM today. So if a 3% move would be considered our average, then we want to take that and cut it in half, which would be 1.25 or 1.5%, and add that to our current location. So there's our 4% move. We'll just start there, bring it up 1.25 to 1.5. There's no mad science to this, right? We're just basically asking if that's normal and we were to go above normal or beyond normal, what would a normal target be? And the way the indexes work, they really do hit those quarters and midpoints. So, 1%, 1.5%, 1.25%. It's very common to see that. We can just lean into it and use that to our advantage. These are like guides in a tour, right? If anybody is a fisher and you go out and you mark your targets out on the lake with your depth finder, when you go back later on, it's not like you're going back to that exact perfect spot, right? You're just going back in that same area when you go back to the lake again the next time. You just want to be in the general area. And that's what we're focusing on here. Because as the day unfolds and we move through these areas, it's not like we're aiming right for that line. We would be using the intraday values and our intraday measures to get to those lines. The reason I measured 4% is because we're down 1%, right? So if we were to take that 1% back and just get to zero, we still have an ADR, an average daily range of 3%. So we take back the one that we are down, and then we add that 3%. Now that's a controversial argument there. Other people say you shouldn't do that. If the entire range is 3%, then we should use the down percent that we already have, the -1, and then 2% to the upside. I used to believe that technical analysis was just technical analysis. You could only do it one way. And when I studied more about it, I found out that there's a lot of different ways. There's Wyckoff, Dow, O'Neill, and there's so many different styles out there. So if you want to do it the other way, it's not wrong. You would retrace the 1% and you would just make a 2% move from our current location. And that would be the entire ADR of 3%, right? So a 2% move, if you retrace the 1% that we're down and then put a 2% move onto that, that would put us at 40.47. We'll call it 40.50. Never agreed with that style personally. That doesn't mean that I'm right, right? So that's how you would do it. Because if you think about the way ADR is measured, it really does use all of the candle, right? So like the indicator that we're using here, 21-day ADR, it measures from the highest point of the day into the lowest point of the day. And then it does that for 21 days. So it's not looking at how far the market has moved to the upside or the downside. It's literally measuring whole of the move from the lowest to the highest. And from with that in mind, it would make sense to do it this way. So as usual, when we draw these lines, we need to lean into something more than just saying, "Oh, well, there's a wick there or a pivot point there. There's previous price action here. Maybe that's a pivot point." We have to have more than that. Something like the value area high, the value area low, point of control, some volume node. So as we can see, we are inside the box. We're on the lower end of the box. We have every expectation of traveling from the low of the box to the high of the box. The point of control is over our head and centered in the upper middle quarter. If we were to break this down into 4 parts, or even in the upper third, break it down into that, there is a significant level of volume at 39.70. So there's going to be a lot of resistance when we get back into yesterday's high, if we are to go that high, right? Even just to get there, and we'll go back to the S&P, there's a lot of resistance before we even get there. But there's a large amount of resistance at 39.80, and it's volume resistance. So that's important to recognize. It's not like active resistance, but you have to think about how many traders are trapped in there. How many institutions would really like the opportunity to get the heck out of that trade that they got into, because somebody was buying those highs, and it's very likely that they are trapped in those highs. $39.80, significant level of volume. POC at 40.11 ish. So the point of control, or the point of control is at the COG. That's COG, center of gravity. So should we break through yesterday's highest point, the center of gravity would be my first target to the upside. Like milestones or goalposts along the way, that would be my first target if we manage to break through yesterday's high. There is an untouched point of control from yesterday. We always carry those forward. We're just going to steal this line from up here. Virgin point of control, or an untouched point of control. If you'll notice, I didn't get too specific with it. It's in the right area. It's close enough. There's never a reason to try to like zoom in and get that thing down to the tick. It doesn't need to be that exact. When you're drawing on your charts and messing with technical analysis, really consider the idea that you're using a fat crayon, not a sharpened pencil, right? Because price doesn't care about your lines. It's not going to stop on a dime. And when it does stop on a dime, that's considered weak. If you get into TPO analysis on Thinkorswim, that would be the monkey bars. If price sets a low yesterday and we run down and hit that low today and bounce off of it, that's considered a weak low, right? So if you actually hit a pivot point and stop on a dime, that's weakness, not strength. So we have the untouched point of control of yesterday. We still have an untouched point of control from Friday. So we are now bracketed on each side by a point of control. Those will be places where we anticipate a reaction in price. So coming back to today's session, we talked about the upside, we talked about the downside, but there is a considerable amount of talking that needs to take place when we are thinking about this gap. This is a significant gap. It left volume, like a vacuum of volume or a vacuum of liquidity behind. A gap like this very, very often is retraced, or at least there is an attempt to close the gap. But it's going to be a significant level of resistance too. So I have every expectation that no matter what we do, going bullish or bearish, we're going to try to close this gap. That makes each side of the gap a gravity point. Gravity wouldn't be the word that they use in technical analysis, but that's what it becomes, right? It becomes a target. So you can see the white line is VWAP. You can see how price has been responding around the VWAP. We're kind of crisscrossing back and forth through it. If we hold above VWAP, we have every expectation of going to the gap. If we manage to get through that resistance, which on first touch, I don't expect to get through it. But if we finally get through that gap bottom, then we need to anticipate a Busby. That would be where price tests against resistance, finally breaks through it, and then validates the old resistance as a new support level before continuing on. I call that a Busby. You won't find that anywhere in any technical analysis books. Some grumpy old dude named Busby was yelling at people in a class about that, and I named it after him. I'm sure he appreciates it. But we'll anticipate that retest of the old resistance as a new support, and then the target would be where we closed. Now, there's always the discussion of which close should I use, the 4 o'clock close, the 4:15 close, or the 5 o'clock close. The easiest way to answer that question is just go out to the daily chart. Where was the daily close at? As the broker describes it. That's where the broker says we closed, because that's what the daily candle says we did. So if we get through the gap bottom, we validate that old resistance as new support. We have to still get through the volume point of control, that untouched point of control that we had talked about. Then we got to get through that gap top. That's also going to be a significant level of resistance. So this bull and bear target that we were talking about first has to take into consideration this gap. This gap is going to screw with everything today. You have to really kind of consider how many organizations and firms got trapped in this, and then they're going to work on resolving it. Right? Plus, price just does that. Right? We've seen it a million times. Price will work very diligently to resolve that gap. If it's not resolved today, then it's likely we won't resolve it for a while. Right? Gaps can remain unresolved for a long time. Since this one is over our head, sooner or later it will be resolved. If it was a gap underneath us, there could be years before it was ever resolved, right? But this one's over our head, so it's very likely we're going to resolve it today. First, for the NASDAQ, Just like with the S&P, we've got the same issues. Yesterday's low and yesterday's high is our boundary that we want to focus on. If we remain inside of that, then we're just inside day. It's a significant range, so there's plenty of room to have a decent trend, plenty of trade opportunities. It's tradable, but that would still be our range case. And you can break that range case down into at least two zones where we opened to our low or our entire Globex as one zone, and then that gap that needs to be resolved. If you put the two zones together, that makes all of our range case. We do have an ADR of 4%, and we are down nearly 2%. So if we complete the measurement to the downside, we would just add another 2.25. That gets us down to the volume point of control, 11,570. If we're close enough to that quarter, I would expect 11,575. But that Virgin POC is also our ADR measure, and that would give us a 4% move to the downside. Remember, that would just be normal. If we happen to get below that, Friday's low will come into play. That would get us into extreme. We'll call it extreme target 1. And below that, we would need something else like our own intraday internals to help target those downside moves. But the VPOC is also our ADR right now. So unwind that and run it the other direction. If we're looking at a bull move, even with all of the different economic events today and all of the different speakers, we're down 1.75. So if we retrace that 1.75 and we add a quarter, that'd put us at 2. Put 2 more on that, and that would be our 4% move to the upside. Probably easier to measure just from where we closed, and give it 2.25 from there. It's close enough to 12,350. That's what I would hit. So that would be an alternate ADR target, not the one that I would use, but it matches the discussion we had just a little bit ago. And the same thing from the close, if we do it the way I normally do it, a 4% move from the close. We'll call it 12.55. Now remember, if we move that far, that would just be normal. That wouldn't even be extreme. That would just be our average daily move. And it would put us back to the top of the box that we've been struggling with for 2 weeks. So if we're talking about breaking out beyond that, everything would be lit up. UVol, DVol, tick trend, advanced decline. We make a move like that, everything's going to be lit up. It won't be like yesterday with that slow grind and the mixed internals. It'll be lit up like a Christmas tree, right? You'll have all three of the risk on sectors running in the same direction. You'll have the MOT, likely you'll have Bitcoin, everything, right? And you'll have a soft dollar fading off against that move. If we start focusing on extremes, we would have to look beyond that range. And I would say that that VPOC target at 12.8 is a good bull case extreme target one. It's worth looking at where is the weekly expected move. We didn't do this in the ES, but we should have. If we're going to hit that alternate target, or if we're going to just expand our ADR today, we still need to know where's the weekly expected move. That's 12.2-ish. The hand-drawn measures are more accurate than the indicator, but the indicator is better than nothing. Saves you a lot of work. That expected move, by the way, for those of you who don't speak options Greeks or nerd out the way the rest of us do, this is where your expected move comes from. So you can use a dynamic one or a static one. If you use the dynamic one, you're using it every day, coming in and asking, what's the EM today? If you're using a static one, it's every Friday at the close. You mark what next Friday's close would be. Right? And that's where the weekly expected move comes in. All right, so looking at the volume profile, we are inside the box. We do have a point of control over our head. It is the greatest level of volume, and that is a volume resistance. But if we happen to get through the close of yesterday, we've got a nice shallow area, not a lot of resistance, and we should be able to move through that shallow area easily, considering, easier, and hit our ADR alternate target at the very least, which lines up really close with the value area high. So that nice shallow area, price moves through those shallow areas easier with less resistance. And it's always important to recognize where on the box we're at. Are we outside the box and moving farther away? Are we inside the box in the middle? Are we at the low or at the high? Looking at a 5-day, 5-minute, we call mapping out the 5x5. We've got an untouched point of control now from yesterday. So on any discussion of a break to the upside, resolving the lower end of this gap and trying to get back to where we closed yesterday, we're going to need to get through this volume point of control from yesterday. So it's worth revisiting as we get closer to the open. Quite a few things can change. And one of the things that can cause a change, the dollar opens and the bonds open between 8 and 8:30. We had a significant breakdown in the bonds yesterday. And if you look at what happened in the dollar late last night or early this morning, however you want to look at it, we had a very aggressive move. And we're not seeing the reciprocation in the S&P and the NASDAQ that we would have expected, right? We didn't get anything. So the dollar dropped and the S&P and the NASDAQ just continued this wad of nothing, right? It was like just a compression shelf and nothing happened at all. Yesterday, we kept expecting the dollar to make significant moves, and it wasn't doing anything. It didn't participate. It didn't offer any insight. There was just nothing there. Even last night after the gap, when we opened back up in Globex, we really didn't see very much out of it. It bid up a little bit, but it couldn't even break through its own intraday high from yesterday, and then it faded right back off again. So really keep your eye on these two. When what should happen doesn't happen, it should cause you to pay particular attention, right? One of the things that got my attention yesterday was we started getting that liquidation breakdown in Bitcoin. Now we're not getting into the idea of correlated states or correlation coefficients or anything like that. We're just talking about this thing as a risk asset, right? If you're feeling frisky or want to get extra risky, you play around in digital currencies like Bitcoin or altcoin or any of those currencies. When seeing this thing make a significant liquidation break yesterday afternoon, that was a heads up. It certainly got my attention, and it wasn't long after that before the S&P had a significant liquidation break of its own, but it nowhere close to what we saw in Bitcoin. The move in the dollar was reflected also in the oil. We did see some reciprocation in the bonds, but we got nothing out of the stocks, right? Nothing out of the NASDAQ, nothing out of the S&P. So I want to continue to keep our eyes on these things, but when they're not doing what they're supposed to do, they kind of leave us with our hands in the air, kind of asking like, well, what are we supposed to do now? We're not getting any signals out of this that we can use. I mentioned it at the start of the briefing that the advanced decline line yesterday was one solid signal that never failed us. The cumulative tick yesterday, this thing is responsive enough that it turned bearish in these pullbacks. And they were significant pullbacks, so there's no argument there. It was a pullback, but it wasn't a change in market sentiment. The market didn't flip over, turn bearish, and retag the lows of the day. It just went weak for a while. And you got to remember, Bostic was talking, a lot of different people were out there chipping their teeth. So some of this is a reflection of what they were talking about. But the advanced decline line stayed strong and bullish all day yesterday. This thing never wavered. So it's a good argument for why we look at all of these different values and not just one single tool by itself. Right? Look at all of them, each of a piece of the puzzle. And when you put all the pieces together, the puzzle presents you with a clear picture, or hopefully a clear picture, right? All right, so what do we got for today? Start with the sectors. We know we need the risk on sectors if we're going to turn bullish. The risk on sectors would be finance, tech, and consumer discretionary. From that, though, we really only need one of the two. Yesterday, finance really, really pitched in and helped out, right? Some of that lack of tech to a point, tech did come in later on, but at first it was all finance. And that divergence really threw off the models that we would use. MOT is a phrase I've been using more and more instead of the FANGs, right? That acronym is kind of broken because it was FANGs, then it was FANGman, then it was FANGman plus T, and the acronym is just all screwed up. But MOT still sticks. Monsters of Tech. We've been using those. They're as good, perhaps even better than just straight up looking at the sectors. Now, there is an NYSE FANG symbol now. So if you don't have Thinkorswim or you can't make your own conglomerate ETF the way we do on Thinkorswim, you can actually just hit it up in Google. But depending on what broker you use, you can find something like this. This is exactly what we're doing on Thinkorswim. Somebody put all of those markets into one single symbol, and you can see that symbol through the day. It is a reflection of the monsters of tech, right? Just kind of keep in mind it's likely delayed if you're getting it off of, Google or Amazon or Yahoo Finance. So, be aware of what you're getting and where you get it. This only has intraday, whereas, when we're using Thinkorswim, ours tends to work even outside of market hours. So you have the market monsters of tech, and then you have the risk on sectors: finance, technology, consumer discretionary. If you don't have at least one of those three sectors, you're not going to get a bullish move in the market. Or if you do, it'll be directly connected to like some econ spike, a spike rather than an actual traveling trend with higher highs and higher lows. It'll be like a bidless beast just dropping like a rock, right? Or an extreme expansion candle or something like that. So when we're looking at the sectors, we always want to look at what's alternate. We're down this morning a lot. It's easier to focus in that situation on what's not down because everything is down. So what isn't? Bonds, Bitcoin, the devil's metal, silver, those are up this morning to a degree. And then we want to focus on what sectors aren't covered by the old school legacy sectors. We can start with something like emerging markets. This is our global risk on, risk off gauge. If that's down, then we have an expectation that the global marketplace is in a risk off sentiment. And we're gapped down, and the market hasn't had a chance yet to flip everything over and run that gap. So a lot of these that are down, at the very least, we would expect some reciprocation. And that may be worth playing at the open, just running things to the gap close. Not a bad way to go. If this is more of a knee-jerk reaction to a CEO chipping his teeth yesterday, the markets overreact a lot. They're very likely going to reclaim this gap and continue to go forward from there. It's not the first time we've seen that kind of knee-jerk reaction, right? So the market could just wipe this whole gap right off and go on with his business. If that's the case, the ones that are down the most would be the ones worth focusing on at the open. These sectors, however, don't cover the more modern world that we live in, these old school 11 sectors in the S&P. So we want to break out our own, put chips in their own category, kind of ask what's going on in the chip sector, what over there may be worth focusing on or looking into. They're down, obviously, because everything is down. Which ones are down the most, or which ones aren't participating with their peer group? I always look for anything standing out. Who's bucking the trend or going against their peers? In the crypto space, same question. Who's down or not down? How do they stand out? Who's their peers? Electric vehicles, nothing really standing out there. It may seem like a pointless exercise because we already know everything's down, but it's the odd man out that we're looking for. Any particular reason that something is standing out above and beyond its peer group so that we can follow that up and often find an opportunity in the morning. So XXII is it's in the pot group, but it's a real estate company that helps marijuana companies find real estate. So it kind of fits into more than one category. So there's going to be some changes on the schedule in the Bullish Bears chat room or main room or whatever you want to call that room. And I'm sure Lucian will be coming out with an email or a video on this. But Fridays, I'm going to use that stream day for 0 days. So we're going to exclusively focus on the 0 days strategy on Fridays. Obviously, with the SPX having 5 expirations in a week, we don't have to wait for Friday. We can do it every day of the week now. But on Fridays, we can run the 0 day on everything else, right? Anything that's a weekly options product has a 0 day on Friday. And since the 0 day trade is a money making nut and it's one of the easiest trades that we can focus on, and it doesn't require a trend day, it doesn't require a momentum day. It doesn't matter what the markets are doing, we can trade a 0 day on Fridays. So I'm going to start using Fridays to exclusively focus on those 0 days. There's a lot of junk that I need to help people get rid of, right? These YouTube weirdos out there that are promoting the idea of doing 10 delta far out of the money options trades, extreme risk, high risk trades. We got to dispel that myth that that's actually a good trade and try to show you guys a better way to do it, right? A more consistent, profitable, thorough way to do it, and ways to mitigate the risk, to roll them when they're working really good, to try to adjust them when they're not. There's a lot to a 0 day. Just like with my morning briefings, where every day I come in and try to show you guys how to do a morning briefing more than just trying to give you a briefing. I've tried to do videos on the 0 day. I've done a couple. They're in the Bullish Bears Next Level library. But I think doing them live every Friday, working with whatever market we happen to have on Fridays, will go a long ways and really help people get to the point where they can consistently trade them and recognize when you maybe shouldn't be trading them, right? Because just because we can do a 0 day doesn't necessarily mean we should do a 0 day. That's what I got for you guys. Be careful, be safe. I'll see y'all tomorrow.